My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll do my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, put everything in the context. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. Who is Nvidia? What is she? That all our swains commend her. Holy, fair, and wise is she. The heavens such grace did lend her, that she might admired be. Yep, I have to default to Shakespeare, no less, and that great verse from Two Gentlemen of Verona, the one that sings the praises of the wonderful Sylvia, and the power of love felt by all for this goddess of uncommon beauty, both outside and in. Well, isn't that what Nvidia's become? On the eve of its quarter, with the whole market on tenterhooks, the Dow advancing 10 points, and she got 0.16%, the Nasdaq gaining 0.16%, we have to ask, who is Nvidia, really? And what is she? Now, you may think it's silly to quote the bard at the top of a business show. But frankly, in all my 43 years on Wall Street, that's right, right here, 43 years, I have never seen anything like Nvidia. So I scrounge for analogs and come up grasping for something ethereal to match the ardor of this wonderful company. This $3.2 trillion enterprise, worth $580 billion just 18 months ago, has captured the hearts and minds of people who have nothing to do with the stock market at all. I've never seen so many people have a life-changing experience from a single stock. It's borderline miraculous. But tomorrow at this time, Nvidia stock will descend into mere mortality. So I feel compelled to explain why Nvidia has this exalted status and why it, frankly, can never live up to the hype of its $3.2 trillion market cap, purely on the basis of one upcoming quarterly report. Why? Because in the end, the quarter's about Nvidia beating the earnings estimates, topping the revenue numbers, and crushing the forecast. The stock has run so much into the quarter that it needs a $2 billion revenue beat. It also needs the revenue guidance to come in $2 billion higher than expected, along with a bullish conference call that talks about a multi-year roadmap. Oh, and let's throw in a gigantic buyback because the company simply got too much cash to leave sitting in the bank. Unfortunately, Nvidia, like Sylvia, simply can't be captured by such a pedestrian set of figures. It's almost a travesty that this Prometheus can be bound by the chains of the estimates. What's the problem here? First, let me just say that the vast majority of people who own Nvidia probably don't even know what Nvidia does. They know it's a semiconductor company, which is really only partially true. They know its chips are lightning fast, but they don't know why that matters. They know it has something to do with artificial intelligence, but maybe it's better than real intelligence? Nvidia has actually created an entire platform of hardware and software that's trained to give answers and infer what you may need depending on the task. Nvidia has the fastest chips known to man or woman, and because they're so fast, they can digest all the information in the world and spit it back in a smart, digestible way. A knowledge worker can prosecute that data and figure out things that were unfigure-outable before Nvidia dreamed up this business. You've used artificial intelligence if you've ever taken a recommendation from Amazon. That's called inference. Amazon puts all your data through this technology, so it'll almost always be right because it mimics your brain. Generative AI, the kind that heavily relies on NVIDIA's technology, is artificial intelligence on steroids. It generates new content, often via text. Think ChatGPT, Gemini, Claude, or Meta AI. It also creates images that look like they were made by a human. It can write music better than pretty much any living composer. Other companies, notably AMD, have chips that can do a lot of what NVIDIA can do, but NVIDIA has a big edge thanks to its CUDA, C-U-D-A, computing platform, combined with its high-end chips, which allow smart developers to write code. It's a virtuous cycle, people. The more training, the more writing, and so forth and so on. NVIDIA's architecture allows simultaneous calculations that can mimic real humans. An NVIDIA-powered set of GPUs that are part of the next-generation Blackwell chip can digest Moby Dick in an instant and tell you more about it than the average English professor, or even the best English professor. There's nothing like this. That's the story told in the language of authentic Silicon Valley gibberish. Let me tell you what's really going on here, though. Jensen Huang, the CEO of NVIDIA, has created a platform that's unduplicated by anyone else, both for its speed and for its utility. The new platform, Blackwell, can ingest images and teach us how to do things that we'll never be able to do without its assistance. Well, let's consider a simple example. No pitcher, no matter how good, not Sandy Koufax, Christy Matheson, not Bob Gibson, not Cy Young, could strike out every player while pitching a perfect game, right? But a robot supercharged by Nvidia's Blackwell platform would have studied every pitch and every swing ever, programming itself to throw an unhittable ball every time. Generates that. A game where every batter strikes out would be child's play for the robot. At the same time, a robot could study every drink ever poured for James Bond and make a perfect martini every time. In more prosaic terms, it could load and retrieve boxes perfectly, never getting hurt when they fall. Maybe it can't make every one of the 3 billion drink combinations at Starbucks, but I think that's asking too much even for a genius like Jensen Huang. But you can see that Blackwell is basically challenging not the sound barrier, but the speed of light, even as we are taught that nothing can exceed light's performance. I think our own brains are just too small to figure out all the implications. Fortunately, Jensen's brain isn't, and he knows the throughput, enough about future iterations of this platform that could make Blackwell look positively antediluvian in a few years' time when he comes up with the next iteration, and the next iteration after that. Again, we can't know how all this computing power will be used, but it's definitely going to get put to work, and I bet it'll be revolutionary. But that's the problem. We don't know how to use all the power, at least not yet. So we don't know how to comprehend how much of a game changer Nvidia chips will be in the future. But just because we can't envision it doesn't mean we won't be able to use it. We do know, though, that in the end, this greatness must be captured by the chains of earnings per share and revenue forecast, which is what will happen tomorrow evening. Why aren't I more concerned? Because every major company, from Meta to Google to Amazon and Microsoft, wants Nvidia's best chips. They want them because they have smart people who will be able to figure out what to do with them. In the same way that Sam Altman of OpenAI figured out how to use ChatGPT to create everything from haiku to music to paintings. Picasso, Cezanne, Matisse, they're no longer with us. But we can see what they would paint. Mozart and Beethoven checked out ages ago, but I could see Blackwell writing the Saturn Symphony to go with Mozart's beautiful Jupiter number. Or maybe we could all at last year Beethoven's 10th. I can't wait until Nvidia brings us Macbeth Part 2. He's back and he's bigger than ever. All these wonders are so fanciful, so impossible that we can't really get our heads around them. We don't know enough to use these platforms other than when they're reduced to the almanac of all things that we can query, like ChatGPT. No, Google doesn't need to buy Nvidia platforms to keep up with Amazon. It needs them because its people can figure out things they can't figure out without them. It's about survival. You get Blackwell or Wither and others like Elon Musk or Amazon's Andy Jassy just surpassed you. You won't catch up. When you think of all these wonders from NVIDIA's technology, you don't sit there and worry about how massively they can beat the estimates in one particular quarter. We can't judge NVIDIA like other companies, so we certainly can't judge its stock by one static quarterly snapshot. The bottom line, I don't want to be picayune. So I say to NVIDIA, let us sing that NVIDIA is excelling. NVIDIA excels each mortal thing upon the dull earth dwelling. To her, let us garlands and upside surprises bring. Let's talk to Eric in New Jersey. Eric, you're up. Well, perhaps we should go to John in Kentucky. John.
Hey, Jim, thanks for having me on. A real fan of you and your show. Listen,
well, thank you very much.
Cybersecurity. I'm on this. Okay, we appreciate it. I've owned this. I appreciate you. I've owned this cybersecurity stock for the last 3 to 4 years. Bought it on your recommendation, and over most of that time, I've made really good money on it. But the last 6 months, it's been dead money. Jim, should I continue to hold it, or should I sell it and buy another cybersecurity stock? The stock
and that one is
Palo Alto Network, PANW.
All right, Palo Alto's up 18%, not shabby. It's probably up the most of any cybersecurity company now that CrowdStrike has stumbled, although I think CrowdStrike has bottomed, as I said, at the 230 level. I think Palo Alto's worth holding. Now, we trimmed it just a little bit because we bought so much on that big breakdown that we don't want it to be our biggest position. But I say stick with Palo Alto, stick with Nikesh Arora. I think he's a winner. I think the stock's a winner. Stephen in Illinois. Stephen.
Hey there. Hi, Jim. Happy to hear your voice again. I'm continuing to see more and more people wearing this brand, especially when I go to Starbucks. I hear it's one of the most comfortable shoes, but I know you always say there's a difference between a good stock and a good company. Now, my question is that valuation for OnCloud Holdings getting ahead of itself, grinding?
No. On Holdings is a terrific company and a terrific stock. I have been championing this thing since 23. The shorts have been all over it. The shorts think that this company is just another flash in the pan. And FITP. They are wrong. I would be, if I were at Nike, I would be worried about On. I would be worried about Hoka, and I would be worried about New Balance. And I would be shaking if I worked there. And I'm not talking about shaking a boss, like Paul Newman. I'm talking about really, really worried. No cool hand loop, but cool hand shoe. Kathy in California. Kathy.
Hi, Jim. How are you?
Good. How are you?
Good. First time caller. I just wanted to call in and ask your opinion about Merck. I'm down in my position, and I'm not sure if I should just hold on to it or what to do.
Kathy, Merck got hit by the Chinese stick when it reported last, and a little surprising. We didn't expect that. It's happened. It happened to our Dan and her at one point for our Charitable Trust. I say Robert Davis. Rob is doing a phenomenal job. Here's what I want you to do. I think tomorrow you buy more Merck. I think it's a very inexpensive stock with a 2.6% yield and very, very well run. At 14 times earnings, I think it's a bargain. Look, when you think about all the wonders created from Nvidia's technology, you can't judge this company like others, and you certainly can't judge the stock based off of punk quarter. And two gentlemen for owners, pretty swell, isn't it? Man, Money Tony, are major changes coming to the ownership structure in the NFL? I'm sitting down with the owner of the defending Super Bowl champion Kansas City Chiefs to get a read on what deal means for the league right before the new season kicks off. Then the market is gearing up for Nvidia's earnings tomorrow. As I mentioned, I'm going to go off the chart to see how much of a make-or-break moment it really is for the major averages. Plus, I'm investigating the state of the IPO market to see where all the new offerings have gone. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Today, we saw a major shift in one of the most important businesses that's not available for trading. I'm talking about the NFL. We just learned that the NFL will allow a small list of pre-approved private equity firms to buy up to 10% of a given franchise, although the NFL itself may take a small cut of their gains. Given just how dominant the NFL is in the ratings department, there's a lot of interest in what the deal means for the league. Luckily, we have one of the best owners in the league with us tonight, Clark Hunt. He's the chairman and CEO of the Kansas City Chiefs to explain what it means. Mr. Hunt, welcome back to Mad Money.
Thanks very much, Jim. It's great to be on with you this afternoon.
It is great to see you again, sir. You are on the special committee of owners that was looking into this possibility. You are a family person. I regard the league as family. Why would you want an entity that is really purely about money to maybe interrupt or be part of the family?
Well, you're exactly right in that our committee's done a lot of work over the last year, and this is something that we've been considering as a league for 5 years when some institutions started investing in other sports leagues. We just felt it was the right time for the NFL. We're definitely taking a baby step, limiting the investments to only 10% of each franchise. We think the capital will be very helpful to teams as they look to grow their business and improve the fan experience.
So let's go over. I imagine that the PE firms that are attracted maybe to franchises that don't have as much money as other franchises. Your franchise is very wealthy, but is it worth it to have a PE firm come in when it really may be a situation where other teams need more money?
Well, many of the franchises in the National Football League have had limited partners for a number of years, and this is really just another step in that regard in terms of adding institutional capital. And you're exactly right. That capital can be used for a lot of purposes. I think most importantly, it'll give teams that are considering new stadiums or renovated stadiums an opportunity to access a capital pool that they haven't had access to in the past.
Now, Clark, I wonder sometimes if I were at one of these private equity firms, obviously they don't do anything for just the goodness of their heart. They want to make profit. Is it possible that they're thinking, you know what, a $10 billion franchise could be, because this company, the NFL, is so well run, could be worth $20 billion. So I want in that next $10 to $20 billion amount.
Yeah, well, one of the things that we found during the process was there was significant interest from a very broad array of private equity firms. And I think their interest is driven by several factors. First of all, investments in sports franchises tends to be uncorrelated to other asset classes. Secondly, many of these firms have already tipped their toe into investing in sports teams, both in the other U.S. sports leagues and in some cases in European soccer teams. So they had experience in the space. And so they were really excited about the opportunity to invest in the NFL. And the group of firms that we ended up with is about as blue chip as they come, and we couldn't be more pleased.
No, these are the best of the best. I wanted to ask you, the Philadelphia Eagles, which you know are near and dear to me, they opened Sao Paulo, Brazil, against Green Bay. We've seen lots of games in Frankfurt. We've seen them in Britain. What is the is that to familiarize other countries with the NFL? Is that for merchandise? Or is that to hope that one day these countries, like the NBA, will produce their own football players and maybe have teams?
Yeah, well, something the NFL has been focused on for many decades now is the growth of the game internationally. My dad back in the 90s was actually on the international committee and was part of the effort that helped create the NFL European League. Today, NFL teams, as you just mentioned, are playing all over the globe, and that's a part of an effort to grow the game on a global basis. To some degree, we have a very large market share here in North America, and if we want to keep making new fans, it's incumbent upon the league and the teams to grow their fan bases internationally.
Now, will you yourself, you've got stadium renovations issue, there were residents of Jackson County where Arrowhead Stadium is located. They rejected a sales tax measure. I mean, this kind of thing is going on in a lot of different, with a lot of different teams, not as wealthy as yours. Would that be the kind of thing that you could see that one of the teams might just say, you know what, if we take private equity money, we don't have to take public money, and we can become a better citizen in our towns?
Well, as I mentioned earlier, I think a lot of NFL teams will use the capital for different purposes, and that includes stadium development. In the case of the Chiefs, we're working on developing options across the metropolitan area. We think we're going to have some very good options, whether that's a renovation of Arrowhead or whether that's the construction of a new stadium. So I don't know that we'll actually access this new pool of capital, but I know for some teams it'll be very important.
How about the salary cap, Clark? Could you see and envision a day when the salary cap goes up even more dramatically? Because I think a lot of fans just want to see the best product possible. Maybe the salary cap is a limiting principle.
I'm not sure that the salary cap is really a limiting principle. I think it's a key cornerstone of the parity that the NFL enjoys and why there's a handful of teams every year who are capable of getting to the Super Bowl and winning it. Certainly the salary cap is going to continue to grow. It's been tied to our revenues for several decades. It's been a great partnership between the players and the clubs, and we think it's a model that really works.
Now, I know it is presumptive. You obviously think the Chiefs are going to win. I know, having been there on the -9-degree day, that you have a very special feeling when you go to a Chiefs game. There is truly a family of fans. Is it possible one day that we could see a PE firm and maybe even a Green Bay-like experience where we get a piece of the team ourselves? Could you ever envision, instead of just being a season ticket holder, we could own some of the Eagles, own some of the Chiefs?
Well, certainly that's an opportunity for anybody who's investing in private equity. We approved a group of 4 funds or fund groups today. And I think there are probably some individuals who may become interested in investing with those funds because they're going to have access to NFL teams. You're right about our experience in Kansas City. It's absolutely special. The Chiefs Kingdom is one of the best fan bases in all of pro football. And none of us are ever going to forget that -6 day in Kansas City for the playoffs. It was great to be there with you.
I can't believe my phone still works. Well, next question. We do get reports that the NFL wants a piece of the PE firm's profits. Can we confirm that?
So our negotiations with the firms are ongoing. Today we took a step towards preliminary approval of the funds that you're aware of. That process will unfold over the next few months. I do think that the NFL brings a lot of value to the funds who are going to have this opportunity, and we'll certainly be talking to them about the overall economic structure.
Excellent. Last thing. Taylor Swift was at our game. My wife watched the football game for the first time this year. Will she be back, do you think?
Well, we definitely have a new fan base as a result of Taylor coming to some of our games last year. Don't know what her plans are for this year, but certainly happy for she and Travis Kelce and their relationship.
Well, people have to know it is a very special place to go and watch the Chiefs and Coach Reid and everything that you've done for the NFL. Thank you so much, Clark Hunt, Chairman and CEO of the great Kansas City Chiefs. Sir, it's great to have you on the show.
Yeah, great to be on with you. I hope to see you at Arrowhead.
Oh, I sure hope so, too. Man Bunny's back after the break.
Coming up, Cramer takes to the charts for answers. Does it all come down to Nvidia? Keep it right here.
We've had a remarkable run from the lows 3 weeks ago, as we realized that the forced selling caused by the implosion of the yen carry trade is merely temporary. Now the Fed is our friend again, with rate cuts on the way starting at next month's Federal Open Market Committee meeting. At the same time, though, after such a spectacular rally, Wall Street's gotten a little more discerning. Investors are no longer willing to give companies a pass for less than stellar results. Once we reach more exalted, elevated levels, well, that's what happens. The exuberance goes away. Now we're in a tricky moment that feels like a race against time. While the economy is slowing, we know the Fed rate cut cavalry is riding to the rescue. We just don't know how effective it will be and how bad things will get before Fed Chief Jay Powell manages to turn the tide, and he will. We need to figure out how quickly the economy will deteriorate and how quickly the rate cuts will work their magic. Both of these are judgment calls, and we don't necessarily have enough data to decide either way. They never do at this point in the what we call the economic cycle. That's why tonight I want to take those subjective judgments out of the equation for just a minute and embrace a more quantitative approach to assessing the market. So we're going off the charts with the help of Jessica Inskip. She's the first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as the co-host and founder of the Market Maker podcast. In mid-April, she told us that the big cap growth stocks were about to get their group back and that the whole group bottomed a little over a week later before making another major move higher. I like that call. Then in May, she assured us that as long as the S&P 500 held above its key support levels, it would be able to keep climbing. Sure enough, it spent the next 6 weeks flying to the stratosphere. So what do we have to do? We have to go back to her. And what's her technical take on this moment? Let's start with a weekly chart of the NASDAQ 100. And we're going to go back to summer of 2021. This tech-heavy index, made up of the 100 largest non-financial stocks in the NASDAQ composite, has turned really volatile of late. It sold off hard in July and the first week of August. Okay, we're taking a look at this. This is big sell-off. And then it came roaring back, but before cooling down a bit this week. So it's like here and then here. That's pretty much describes it. Inskip points out that the NASDAQ 100 has been in bull mode since late 2022. I know you could say, well, wait a second, how about that? But it did go back up. It's repeatedly experienced accelerated sell-offs during the 2 periods of this bull market where it was cooling off and consolidating its gains. It happened last summer through last October. Then it happened again this spring. And now we're seeing, she thinks, similar action. See, there's consolidation. And she thinks we're seeing that now. It could be tough sledding. Inskip says that we're still in bull mode. At the end of the day, an uptrend is when you're seeing a series of higher highs and higher lows. Even when the NASDAQ 100 got obliterated by the yen carry trade meltdown earlier this month, it still ended up making a higher low. It's just that it got there from extremely elevated levels. So we're looking at the NASDAQ 100, and we see what happened here, and then it went back up. Inskip also notes that the NASDAQ 100 still has a bullish trading cycle. She likes to look at the 13, the 26, and the 40-week moving averages, MA, because those roughly represent 1, 2, and 3 quarters, respectively, and this business is measured in quarters. Right now, the NASDAQ 100's 13-week, 26, and 14-week moving average are sloping higher. So here we go. 13, 26, 40. You see the slope? Pretty self-evident. As long as the index doesn't break down below the 13-week moving average of 19,462, here we are going here, 19,462, which is kind of close, over 100 points below where it's currently trading. She believes that the bullish trading cycle remains intact. Of course, if the NDX falls through that floor of support, then the next support level kicks in at the 26-week moving average down at 18,778. So we're looking at the 26 right here, 18,778, okay? And it's followed by another floor of support at the higher high formed on March 18th, which was 18,464. I know this is actually very confusing in here, but you have to just say that if it falls below these levels, it's going to go lower. But if it holds, it's going to go higher. I wish it weren't so. It's not oxymoronic, it's just the way it is. These would represent pretty substantial declines, though. At the same time, Inskeep says there's a ceiling of resistance at the 19,900 level, up more than 300 points from here, and another major ceiling at the NASDAQ 100 all-time high of 2690. So we've got some road to hoe up here. Right now, though, it's the floor support that matters. If it holds, Inskeep remains bullish in the NASDAQ 100. But at the moment, that all depends on what we hear from Nvidia when it reports tomorrow night. Nvidia alone weighs in at more than 8% of the index, second only to Apple, which means its earnings are indeed make or break. That's why we spend so much time talking about it. We need an Nvidia clock. As Inskeep sees it, CEO Jensen Huang is taking a page from Taylor Swift and screaming, "Who's afraid of little old me?" Well, you should be. Taylor Swift, no relation. Fortunately, there's more to this market than the Magnificent Seven, thank heavens. So now we check out the weekly chart of the S&P 500. Now, this is called the equal weight index. This is not the usual that we see when it's just the S&P 500. The equal weight index, this is the S&P as it would look in a world where every stock weighed the same, as opposed to the actual S&P 500, which is weighted by market cap. Inskeep loves this chart because it tells you a great deal about the market's actual breadth, how many stocks are going up or down. In her view, this year is all about the other 493 non-magnificent stocks in the index. And right now, those are looking good. The 13, 26, and 40-week moving averages are slipping higher and acting as floors of support. This is actually much better than the other chart. Speaking of floors, Inskeep says the key is the support level at 6888, okay? Which was where the S&P equal weight peaked on March 25th. Right now, the S&P equal weight is above 7,000. But if we get a breakdown below that key support level, then she says, well, you got to be more cautious. Once again, if we break down big. There is a ceiling of resistance. I'm more worried about the downside than upside after I look at this stuff. The make or break level, the S&P equal weight peaked at 6691. I'm going to go back here. Before the Fed started tightening in early 2022. And if it drops below that level, well, Inskeep believes the bullish trading cycle is kaput. Then again, we've got a long way to go before we're in danger of falling through that all-important floor. By the way, kaput was something we also heard from Larry Williams about the market right now. Finally, how about the weekly chart of the plain old S&P 500? So here we're going. S&P 500, okay? And according to Inskeep, the S&P is in a bullish trading cycle until the evidence suggests otherwise. So what does the evidence tell us? Look, the 13-week, 26-week, and 40-week moving averages, okay, are still sloping upward. Same pattern. Good sign. However, Inskeep thinks this bullish cycle may be losing strength. When you look at the moving average divergence, that's down here, okay? This is called the MACD. It's an important momentum indicator. She sees early signs of a bearish divergence. The S&P just roared higher over the past few weeks, while the MACD did nothing. I would have liked to seen that go up like that. That said, as long as the S&P 500 stays above its floor of support at the 40-week moving average, once again, that's that same pattern I keep telling you about. As long as it stays above that, which currently stands at 5488, Inskeep remains confident that the index remains in bull mode, even if it's not as strong as it used to be. Right now, the S&P is at 5626, so we're well above that support level. On the other hand, we're within spitting distance of the key ceiling of resistance at 5638. Okay, so we're very close, 5638, which represents 161.8% Fibonacci extension of the hideous decline we saw in 2022. Remember, Fibonacci, we often talk about Fib Queen, we often talk about what Carolyn Borodin's doing. These are remarkable levels found in seashells, found in, you know what, I saw it in some crazy thing that was pine tree cones, whatever. But the bottom line, the charts as interpreted by Jessica Inskeep suggest that the NASDAQ 100, the S&P 500, and the S&P equal weight remain in bull mode. But for now, they're playing defense. As long as they hold above their key support levels, everything will be fine. At the moment, though, a lot of that comes down to how the market reacts to Nvidia tomorrow night. That worries me because the stock's coming in hot after a spectacular run over the past 3 weeks. But then again, Nvidia is like it's like no other company. And the other 499 stocks in the S&P 500, well, they may just be mortal fools. Let's take calls. Let's go to Sahil in South Carolina. Sahil.
Hey, Jim. How are you?
I am doing great. How about you?
I'm good. Hey, Jim, I wanted to ask you about Disney stock. With Bob Iger as their returning CEO, do you think he'll turn the company around to make it streaming?
I think they desperately need a new CEO, and I'm sure he agrees with me. They've got to find someone fresh, good look of the industry, someone who's young, someone who's determined, hardworking, and excited about the franchise and is willing to see the upside. Because right now, the stock feels very tired. We own it for the Charitable Trust. It's stuck at the 90 level. I would be a buyer of it if it fell much further from here just because I think there's great value at the franchise. But it is an astoundingly poor stock, even though it's an astoundingly great company. The charge is interpreted by Jessica and Skip point to some defense being played by the NASDAQ and S&P. Remember, I think as long as they hold their support levels, the bull market will remain intact. But a lot is riding the market's reaction to Nvidia's earnings tomorrow night. And remember, if it doesn't hold, the downside is substantial. Much more Mad Money ahead. The IPO market has seen some big winners so far this year. So why haven't we gotten more filings for the months ahead? I'm giving you my take that Apple C-suite is being shaken up, but I'll tell you why it's not shaking my confidence in the company going forward. Own it, don't trade it. No your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Every Sunday, Bill Smith from Renaissance Capital, the IPO-focused research firm that I love so much, sends out a fantastic weekly update. And this weekend, he made a great point. Of this year's 10 largest IPOs, 9 of them have done pretty well for investors. On average, the top 10 have given you a 33% gain from where they came public. Even the one that's down is only down less than 3%. Of course, getting a piece of the actual IPO is usually a privilege that's only enjoyed by institutional investors, not home gamers, at least not at scale. But when you look at how the year's 10 largest IPOs have done since they started trading on the open market, I mean, 8 of them are up from the first trade, and on average, they're up nearly 18%. Let me walk you through them one by one because we've got some real winners here. So far, the year's largest IPO is Lineage, the cold storage warehouse REIT, which I highlighted about a month ago. I like the story, but we were still waiting on some key information, like the size of the dividend, and we're still waiting on it. Lineage is up more than 10% since it came public and almost 5% since it started trading, but it's down roughly flat from where it was trading when I covered it at the end of July. Last week, the analyst quiet period ended on Lineage, and the stock got a smattering of buy and hold ratings from Wall Street. I still think it has plenty of promise, but I can't endorse until I know what the size of the dividend is going to be. The second largest IPO this year, Viking Holdings, the parent of Viking Cruises, which was a huge win for us. It rallied from 27 when I recommended it on May 2nd to 35 and changed today. These guys dominate the river cruise market. I think it's a great stock. Last Thursday, we spoke to CEO Tor Hagen after Viking stock fell nearly 9% in response to a pretty solid quarter. I told you the pullback was a gift, and sure enough, the stock rebounded 6.5% in the past recession. Third, Amer Sports is the sporting goods and outdoor apparel company best known for Arc'teryx, Wilson Tennis Gear, Solomon Winter Sports Equipment, and the iconic Louisville Slugger. Now, I told you to steer clear of this one the day after it came public. I didn't like the suboptimal balance sheet, the exposure to China, the fact that Chinese companies still own a controlling interest. Since then, Amer Sports is up just over 5%. S&P's up about 15%. And that's after the company reported a better than expected quarter last week that gave you a nice bounce, but call me dubious. Fourth, remember the Kazakh super app company, Kaspi.kz, which was one of the first deals of the year. That's actually been one of the best performing IPOs in the top 10, up really 38%, from both its offer price and its first trade. Now, I wish I'd recommended this, but at the end of the day, this one's well outside my wheelhouse. Fifth largest deal of the year, one I joke about a lot, called Waystar, which is a software company focused on healthcare payments. I haven't really covered it, even though it sounds like it was spun off from Waystar Royco from the show Succession, which I love. I'm a little aware of the private equity sponsor here and the fact that the company's only borderline profitable, but it reported a good quarter earlier this month. Stock's up about 26% since it started trading. You could do a lot worse. Better than a sharp stick in the eye. Number 6 is UL Solutions, which helps test consumer electronics and other products. Now, this is basically a for-profit spinoff from a nonprofit entity, UL Standard and Engagement. Remember the Underwriters Laboratories? This still controls the business through a separate class of stock. But it's a nice little business, and I've been impressed by CEO Jennifer Scanlon. She told a very compelling story when she came on the show. At this point, UL Solutions is the best performer in the top 10, up 96% from where it came public, up 60% from its first trade. We featured it twice. I bet it's not done. The next largest IPO is Rubrik. This is a cybersecurity firm that helps customers secure their data. This is the kind of unprofitable software company that went out of style in 2022 and never really came back. But it's also a cybersecurity play, a much stronger cohort. Rubrik's had a good debut, and it's still up 11% from its offer price. But the stock's also down from its first trade. I'd say the jury's still out on this one. The 8th largest IPO, jury's not out on this. Jury's back. It's like great. Reddit. This one's been a pleasant surprise, with the stock up more than 70% from its offer price through, though most of that was the first day pop. Since it started trading, though, Reddit's still up over 25%. That's not bad. After speaking to CEO Steve Huffman, a.k.a. Spez, I think Reddit has the potential to be a good destination for advertisers, but the digital advertising market's gotten tougher of late. Didn't stop Reddit from reporting a pair of strong quarters since it came public. I say keep up the good work, Spez. You're going higher. The 9th largest deal of the year is Astera Labs, which makes connectivity solutions for AI and cloud infrastructure. Nice buzzwords there. Well, it sounds enticing. I didn't like that it spiked 72% right out of the gate. Told you so a few days later. Just seemed way too expensive. If you want this kind of infrastructure, may I please tell you to buy Broadcom, which is owned by my travel trust. Sure, Astera Labs has been nearly cut in half since then, while Broadcom's up almost 20%. Even after this decline, I'm going to say wait and see. Finally, there's Bright Spring Health Services, which had a bad first day, falling from 13 to 11, but since then it's up, making it back to just under 13 at this point. Bright Spring provides a broad range of healthcare services, including home health, community and senior living, and hospice care. That's a pretty good space right now. However, it's got a major private equity backer, and a big chunk of the company also belongs to the struggling Walgreens. If the stock keeps climbing, I worry they ring the register. Walgreens under 10 today. Ouch. Now, Bill Smith of Renaissance Capital highlighted the outperformance among the top the 10 largest IPOs as part of a broader point. Given the strength of these deals, he thinks we could have a lot of IPO activity this fall, with many companies postponing their offerings and blaming market conditions. What market conditions? Are they worried they'll get too much money for their stock? No. In fact, market conditions are pretty bad for a certain kind of IPO. The big ones tend to do well because the investment bankers underprice them in order to lure people back into the casino. But this is a rational IPO market where good companies are rewarded and smaller, unprofitable companies, well, they get abandoned. The thing is, the venture capital firms backing many of these potential deals don't want a rational IPO market. They want an irrational one that will pay up for all kinds of slop, especially dubious money-losing enterprise software companies. Bottom line, if you have a real business that's thriving, you can take it public right now and luckily have a terrific IPO. But if you've got a loss-making tech company, there's no appetite for it. Sorry. At least not at valuations that the original investors were willing to accept. And you know what? I say thank heavens, because this market, well, this makes for the best kind of IPO market for you at home. Mad Money is back after the break.
Coming up, hit us with your best shot. An electrified fast fire lightning round is next.
It is time. It's time for the lightning round. Quick, everybody. That's where I told you the rapid fire. He's saying stock on Taylor, buy, sell, disregard none of the call stock questions ahead of time. I step for the play. You play to sell. And then the lightning round is over. Are you ready? Ski daddy. Time for the lightning round. Quick, everybody. Start with Clement in Florida. Clement.
Clement, how are you, Jim? Thank you very much. I'm one of your simple investors and watch you every single night.
Oh,
and
thank you, buddy. Thank you.
We are a bunch of blind people. We are simple investors, but we listen to you. And you make our life easier, more clearer, and look at what we should buy. Yeah.
Well, you just made my day. It's a long day today, sir, and you just made my day. How can I help you?
Okay. How about ARM, A-R-M?
I like ARM. The stock has come down a great deal, and yet at the same time, I think its business is actually accelerating. I think people right now are all tenterhooks waiting for Nvidia, but ARM is a great stock to buy if Nvidia is a good number. Let's go to David in Florida. David.
Hello, Mr. Cramer. Thank you for taking my call.
Of course.
Sir, my question is this. In my Roth, for retirement starting in January, I have about 4,000 shares of Energy Transfer, ET, for the dividend. Is it safe, the dividend?
I believe that the dividend is indeed safe. I've been back and forth on this, and I believe that they have the coverage, and it's an inexpensive stock, and I like the pipeline companies very, very much here. Let's go to Joe in New Jersey. Joe.
Hello, Mr. Cramer. Thank you for taking my call.
Of course, Joe. What's going on?
I just want to let you know, we've been fishing the Manasquan Inlet off the dock, and we've been catching a lot of fluke, a lot of keepers.
I am glad. You know what? I caught a porgy the other day. My wife wouldn't let me cook it. But whatever, that's neither here nor there. How can I help you?
Okay, I need a dividend payer for my portfolio, and I just want to know if Paychex is a buy.
Okay, Paychex is funny. Every time it goes down, I tell you to buy it. And every time these analysts don't like it, they hit it. And what happens? It comes up smell like a rose. I think Paychex with a 3% yield is a buy. I would buy some here and then wait for some analysts to knock it down and buy even more. The company's an excellent company. I am a client. Gregory in New Jersey. Gregory.
Booyah, Jim. How you doing? How you doing?
I'm having a long day, maybe a good day. We've had some callers who said some nice things. I like a little Shakespeare at the top. I've brushed up on that, and how can I help you?
Well, I called you a couple months ago talking about RTX, and looks like we're at all-time highs, just 6 cents away. The question I want to ask you is this going to be affected? Is the stock price going to be affected by?
It's not expensive. By what? I'm sorry. Affected by. Okay, well, look, let me just say this about RTX. When the stock went down really badly because they had a recall of certain engines, the company bought a ton of stock, and it was really one of the greatest things that Greg Hayes has ever done. Now, Greg has stepped down, and we've got Chris Callio's in there. I think he's doing a terrific job, 21 times earnings. I like it very much. I like the defense stocks, and this one's my favorite. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, the end of an era at Apple. Cramer takes on the big change coming to Cupertino. Next.
Apple stock briefly got rocked this morning after we learned that CFO Luca Maestri, one of the best in the business, is retiring. Luca's a hero. He's been the steward of Apple's massive cash hoard, and he's done his best to add value for all shareholders. His best being much better than almost every other CFO out there. So what happens to the stock upon news of his retirement? Well, Apple goes down $1.50 in pre-market trading, and we get a host of notes saying that Luca's decision is either a mild negative for the stock or a real negative, a reason to be worried and a cause of disappointment and concern. It's been 10 years for Luca, a little longer than the average CFO term, a period where Apple's revenues have compounded at an 8% annual clip, while its earnings compounded at a 15% clip. Apple's market capitalization expanded more than 6 times, from $547 billion to nearly $3.5 trillion today. $547 billion to $3.5 trillion. Maestri has been incredible at planning the success of the service revenue stream, which is now close to $100 billion. He's helped grow the company in key emerging markets like India, Turkey, Thailand, Malaysia, Brazil, and the UAE, which increasingly all when put together are becoming a real force. I'd argue he's been a genius when it comes to buying back stock, too, always purchasing it when it's right, not just repurchasing shares by rote the way most CFOs do it. Given that history, that resume, of course, investors don't want to see him resign from the CFO job, even if he'll go on to lead Apple's corporate services team. The sell-off made sense. But then the next thing you know, total crazy down, the stock goes higher. If you're trading down from that $1.50 level, that's right, it rallies. And the darn thing actually closes up 85 cents. It's a huge turn. But then I think to myself, well, why shouldn't it rally? This is not just any company. This is Apple. The company has a successor all lined up, of course, and that is Kevin Parekh, who's been at the company for 11 years. Currently is the vice president of financial planning and analysis. He handles benefits, finance, investor relations, market research. He's already known by many analysts. I think this is the most seamless possible transition that I can recall. And it's still one more reason why Apple's worth so much money. It's what other companies wish they could do. You can't sleep well at night if you have a portfolio of tech stocks, but Apple's made it as easy as possible this time. Oh, and as typical with Apple, there's also an upcoming event, September 9th, when the new iPhone will be revealed. Tremendous excitement about the next iteration. We're all wondering what it will do differently. Will it be extended battery life, a better Siri, integration with ChatGPT, or something else that we haven't even imagined yet, which is what I like the most of. In the midst of an endless parade of commentators who want you to trade whamma jamma, many of whom make money if you trade, there is Apple, the one and only stock that's run the way you want a company to run, which is why I always say own it, don't trade it. I can't think of a thing Apple does wrong when it comes to running the business day to day, and I know that Luca played a big role in that. The highest compliment I can pay, I bet Kevin Parekh will do exactly the same. I'd like to say, as always, a bull market summary. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.